The following podcast was recorded on Thursday, December 8th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by Sam Rines of Arbor Data Science. Welcome, Sam.
Good morning, Kristen.
Today we want to discuss the outlook for oil markets. There's a lot of uncertainty in the oil market with a new price cap on Russian oil. Global oil supplies have been down due to recession and oversupply risks. And OPEC Plus recently announced its decision to not cut oil production further. Why is this meaningful?
Yeah, it's really interesting how it all plays together, right? You have the price cap coalition trying to cap prices of Russian crude, due to the war in Ukraine. Then you have the reopening of China and all the headlines running around that. And then you have OPEC Plus. I mean, you have these three things that kind of all seem to collide together. So kind of starting from kind of backwards to the price cap, it's really intriguing the way that Saudi Arabia has approached the reopening of the global economy and the risks around that for them in particular. China's their largest market and their largest export market by a fair bit. It's not really that close. Next is Japan, then a little ways down the line you have India, and South Korea. Those are by far their largest markets, and that market share is somewhat under threat. With Russian oil barrels only really being able to go to a couple of places, namely China and India. So it's really important that OPEC Plus both kind of restrain themselves a little bit, right? There is that recession risk. They don't want to flood the world with oil and have oil prices plummet. That's not good for them at all. And they really learned their lesson during the COVID era. So I think there's a lot of pieces to the puzzle to put together here, a lot of which kind of goes through the Kingdom of Saudi Arabia that people really haven't paid that much attention to because, well, it hasn't really been that big of a deal. But as China begins to reopen, you have the state visit currently going on with the Chinese leadership and the KSA. That's another signal that Saudi Arabia and China really do want to get this oil price right and begin to supply markets at least at a fair amount, but probably not as much as the US would like.
We want to touch on price cap ramifications, and there's been a lot of headlines this week. What global supply chain issues have been caused?
Oh, well, we haven't really seen them kind of come to the fore yet. That I think is something that we're going to see probably throughout Q1 of next year. You basically carved out a significant amount of the world that Russian barrels really can't go to. So you have Japan, Australia, Europe, US, Canada. Those are the main, call it the main price cap coalition countries that you simply can't send barrels to. That really creates a Russia sending barrels to China, some other Southeast Asian nations, and other places that need the supply, but also have Saudi Arabia supplying them. So there's a little bit of competition there. So it's more of a, you already had a lack of call it molecules generally, right? Natural gas and oil flowing to Europe. That is more than likely going to be the story of Q1, is that you're still not having those molecules go there, and you're having Saudi Arabia compete for Asian market share, not European market share. So it's much more of a global fracturing of the oil markets and a reworking of global energy supply chains, even more than we had with the war in Ukraine. This just accentuates the tensions there and probably continues to have an effect on Russian oil prices in general, but it much less due to the outright price cap and much more to do with simply Russia only having a few places that it can really ship oil en masse to replace its European and other customers that are no longer buying. That, I think, is the real key here, is China and India are going to continue to get cheap barrels. I mean, right now you're already seeing 55 to 65 type pricing per barrel of oil to India and China. That's likely to continue because you simply have a lack of places to send it, and China and India know that.
We want to take a look at OPEC plus production levels. They currently remain below pre-COVID levels, and why hasn't it made a comeback?
Yeah, because China's been closed. That's kind of the harbinger of a lot of this. Is when China's closed, it's a significant deal to global markets, particularly energy markets. China is one of the largest or the largest importer of crude oil in the world. And when it's closed, it's simply not going to demand as much as when it's open. There's an interesting chart and study that found that China has the longest commute times to the office on average. That, is part of the reason why when you reopen an economy like China, and they say they're going to do it in stages and progressively move out of dynamic COVID zero. As they begin to do that, that does bring a significant amount of demand back online, not just on the manufacturing front and the need to produce more electricity and really ramp up production, but also in transportation. That's going to be another significant driver of demand for energy in China, particularly oil, both in cars, planes, and trains. So this is a significant amount of demand coming online, and probably the reason why China felt the need to go to the Kingdom of Saudi Arabia and really begin to both build the relationship up more and likely, get some oil. I think there's a number of things that are going on here that make a lot of sense. The other side of it is OPEC Plus never really brought a lot of their barrels back online, right? They still have a few million barrels that they could bring if they really wanted to, but a lot of it is that they don't have that much spare capacity. There's been a significant amount of, call it capital expenditures that were overlooked or deferred because oil prices weren't high enough to support additional money in the ground. That's been a problem for OPEC plus. It's been a problem in the US and other countries that were growing production prior to COVID and no longer really are growing much production. It's estimated by OPEC plus in their world oil outlook that it's going to take trillions upon trillions of dollars simply to meet demand over the next decade. That is problematic. If you're Saudi Arabia or if you're other Middle Eastern countries, you have to have a significant oil price in order to justify those investments in a market that is really only growing in Asia and is shrinking to flat in the Western world. So there's a bit of a tug and pull here as to how many barrels you really want to put on the market because you really need that higher price to be able to maintain barrels on the market in 3 to 5 years.
And what's the latest out of Europe?
It's mainly that Europe simply still doesn't have as much supply, mostly of natural gas. Oil's not so much of a problem. There's been some refineries that have been shut down due to some strikes, particularly in England, and there's been a couple on the continent, but not that big of a deal. There hasn't been a significant shortage of fuel supplies or prolonged periods of short supplies of fuels. But natural gas is really the one that's problematic for Europe. You saw Germany just brought on an LNG floating terminal. They need to have a few more of those in order to be able to even come close to making up for the amount of natural gas that they previously received from Russia. That's going to be a story again this summer as they're trying to refill the storage for next winter. I think you're going to continue to have that really be call it the pinch point, not so much on the oil front yet. That may become more of an issue down the line, but it's really going to be a story of whether or not they can bring enough capacity online to be able to receive LNG, liquefied natural gas, from places like the US and Australia.
Sam, in summary today, what should we be watching for next?
Whew. I mean, there's so many moving pieces here. It's hard to kind of pinpoint it. I would look at the volatility in oil. I think that's really what we're going to continue to see. It's not so much that you're going to necessarily see a tremendous spike in price as China comes back online. It's more likely that you're going to continue to see significant volatility with oil prices whipping around, particularly on the front month contracts. But the key to watch is going to be, do we have the supply of oil we need and want as we approach the summer months? That's really when it begins to become much more of a pinch point with China online, the US maybe in a recession, maybe not in a recession. But that's really when you begin to have the supply that's currently out there. You really need to have much more in order to maintain a reasonable oil price. So I think you're going to continue to see volatility in the pricing and probably see pricing begin to tick higher, particularly as we approach the summer.
Sam, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, have a great day.